Everyone said Bitcoin was the safe haven.
Bitcoin as a safe haven.
Bitcoin as a safe haven.
Bitcoin is safe haven.
A safe haven.
The hedge against wars, the exit ramp from broken central banks, the asset that governments cannot touch and missiles cannot destroy. So here we are. The United States is in a war. The Federal Reserve is frozen. Oil has spiked 50% in 3 weeks. And every major stock market on the planet is bleeding. And Bitcoin, it is sitting at $70,000, down from $90,000 just 6 weeks ago, down from an all-time high of $126,000 last October. That is not a safe haven. That is an asset under pressure, pretending it is holding its ground. Today, I am going to tell you exactly why Bitcoin is heading lower before it heads higher. I will give you the specific levels to watch. I will show you the war update that changes everything, and I will explain the one scenario where Bitcoin hits 80,000 in the next few weeks. But first, you need to understand the full scope of what is breaking right now. Let us look at what happened this week, asset by asset. U.S. equities. The S&P 500 has now fallen for 4 straight weeks. It closed Friday at 6,500, down 1.5% on the day, down more than 5% since the war began. The Nasdaq dropped 2% Friday alone, hitting 6-month lows. The Dow shed 444 points. The Russell 2000 small cap index fell over 2% and entered official correction territory, 10% off its recent high. Sector by sector, the damage is spreading. Technology is getting hit hardest. Supermicrocomputer fell 26% in a single session after chip smuggling charges. Micron dropped nearly 5%. Tesla down 3%. The only sector showing any life? Energy. Exxon was up. Chevron was up. Because oil is the only asset winning a war. Commodities. Brent crude hit $108 a barrel on Friday, its highest close since July 2022. West Texas Intermediate crossed $96. Natural gas in Europe jumped 24% in a single session. But here's the part nobody in the mainstream media is framing correctly. Gold, which was the undisputed safe haven winner of the past 2 years, has now dropped 10% in a single week, its worst week since 1983. Silver crashed from $95 to $69 in just days. Even the traditional stores of value are cracking under the weight of this macro environment. And Bitcoin? It is still near 70,000, down less than 1% Friday, down just 0.5% for the week. The narrative you will hear from crypto Twitter is, Bitcoin is outperforming. It is decoupling. It is digital gold finally proving itself. Here's the reality. Bitcoin is not decoupling. It is pausing. There is a difference. And I will explain exactly why that pause ends badly in the next 2 weeks, and then potentially very well in the 4 to 6 weeks after that. Before I get to the downside price target, there is one development in the Iran war that almost nobody in the crypto space has connected to Bitcoin's next move. Iran is now building a vetting system to selectively allow ships through the Strait of Hormuz. This sounds like de-escalation, but it is actually the most sophisticated economic weapon Iran has ever deployed. I will explain exactly what that means for oil, inflation, the Fed, and your portfolio in just a few minutes. Keep watching. And 3 weeks ago, the debate on Wall Street was, how many rate cuts will the Fed deliver in 2026? Today, the CME FedWatch tool is pricing in a 12% probability of a rate hike at the April meeting. That number was 0% 1 week ago. Let that sink in. The market has gone from debating cuts to pricing in hikes in under a month. Here is the chain that got us here and why it leads Bitcoin lower in the near term. Oil is up 50% since the war began. Oil feeds directly into inflation. The February Producer Price Index, released the same day as the Fed decision, came in hotter than expected. PCE inflation is now forecast at 2.7% for 2026. The Fed cannot cut. In fact, 7 of 19 Fed officials now see 0 cuts all year. This is where the bond market becomes the most important story almost nobody is talking about. When rate hike expectations rise, bond prices fall, yields rise. The U.S. 10-year Treasury yield has now climbed to 4.39%, up sharply this week. But it is not just the U.S. UK 10-year gilt yields have broken above 5% for the first time since 2008. Japan's government bond market is cracking. The Bank of Japan is now under pressure to hike rates to defend the yen, which would pull Japanese capital out of U.S. treasuries and tighten global liquidity further. Here's what Andrei Dragos, European head of research at Bitwise, said this week. And this is important. Bitcoin has once again acted as the canary in the macro coal mine. At current levels, Bitcoin is already pricing a recession, while many traditional assets are not. Read that again. Bitcoin is already pricing a recession. That is not a bullish statement. That is a warning that the rest of the market has not caught up to what Bitcoin is telling us. The Fear and Greed Index dropped to 26 this week. Fear territory. Total crypto market cap has fallen to $2.5 trillion. Long liquidations in crypto totaled $493 million in a single 24-hour window after the Fed decision. Bitcoin spot ETFs saw net outflows of $130 million on Wednesday, reversing entirely from the $199 million in inflows the day before. This is not a market staging for a rally. This is a market under genuine institutional pressure, and the price pattern is making it worse. CoinDesk analysts noted this week that Bitcoin's current counter-trend bounce, trading in a narrow, slightly upward channel from its early February lows, is an almost exact replica of the November to January pattern that preceded the crash from $90,000 to $60,000. The bounce looks like recovery. It is actually a pause inside a broader downtrend. The path of least resistance right now is lower. According to Lloyd's List, the gold standard of maritime intelligence, Iran is now developing a formal vetting and registration system for ships wanting to transit the Strait of Hormuz. Several countries, including India, Pakistan, Iraq, Malaysia, and China, are in direct talks with Tehran to get their vessels approved. Iran's foreign minister said this week that the strait is open but closed to our enemies. This is not de-escalation. This is Iran turning the Strait of Hormuz into a toll booth and choosing who pays. Think about what this actually means. Iran is not blocking everyone. It is building leverage. It is creating a two-tier global shipping system. Countries that cooperate with Iran on its terms get oil. Countries aligned with the US-Israel coalition do not. China gets through. India potentially gets through. Japan and South Korea, major US allies who import 90% of their crude from the Middle East, do not. And the targets are expanding. Earlier this week, Iranian-linked forces struck infrastructure in Ras Al Khaimah, one of the UAE's most industrialized emirates. This is not a frontline target. It is a manufacturing and logistics hub sitting next to the strait. Iran is not just blocking oil. It is targeting the supply chain backbone of the Gulf economy. Iraq declared force majeure on all foreign-operated oil fields this week. That means international oil companies have legally suspended delivery obligations due to circumstances beyond their control. This is the kind of event that adds a permanent risk premium to oil, not a temporary spike. The base case for oil, even with a partial reopening of the strait, is 100 plus through April. The extended war case is 135 by June. If oil stays above 110, inflation stays elevated, the Fed cannot cut, and the pressure on Bitcoin from the macro side does not relent. Here is the uncomfortable truth for the Bitcoin as war-safe haven narrative. Bitcoin was supposed to be the asset that thrives when governments fail and currencies debase. That thesis is correct, but it is a 6 to 12 month thesis, not a 2-week thesis. In the short term, Bitcoin is still a risk asset, and right now, risk is being sold. Let us talk price. The current Bitcoin price is approximately $70,000. Here's what the chart and the on-chain data are telling us. Bitcoin's price action since early February has been a narrow, choppy, upward tilting channel. The same structure we saw from November to January before the crash to 60,000. The buy the dip crowd is buying, but they lack the explosive momentum that genuine bull legs produce. Every bounce is getting weaker. Every rally is failing below the prior high. The critical downside level is $69,000. Below that, there is a cluster of approximately $4 billion in leveraged long positions. If those liquidate, the move is mechanical and fast. Analysts are now watching the 55 to 65,000 range as the probable base for the next real accumulation phase. Now here is what could change everything, and quickly. First, one piece of news that barely got covered this week because the war dominated everything. The SEC approved Nasdaq's framework to trade tokenized stocks on blockchain rails. Russell 1000 stocks, S&P 500 ETFs, Nasdaq 100 ETFs, all eligible for blockchain-based settlement. This is Wall Street adopting crypto infrastructure, not replacing it. It is structurally long-term bullish for the space. But in a bear macro environment, even the best structural news gets ignored. Second, and this is the only short-term bull scenario worth taking seriously, if the Iran war moves towards ceasefire, even a partial one, the chain reaction runs in reverse. Oil drops, inflation expectations fall, the Fed gets room to signal cuts, the dollar weakens, risk appetite returns, and Bitcoin, which has been holding 70,000 while everything else crumbled, would be the first liquid non-sovereign asset that capital flows back into. The target in that scenario is 80,000 in the first 2 weeks after a ceasefire announcement, not because Bitcoin's fundamentals change overnight, but because the macro pressure that has been capping it lifts instantly. But here is the timing reality. There is no ceasefire today. Iran is building a vetting system, not signing a peace treaty. The Pentagon is sending additional Marines to the region. Iraq declared force majeure. The war is escalating, not ending. Until that changes, the macro pressure on Bitcoin is real, present, and pointing lower. Here is the complete chain in one sequence. War drives oil above 100. Oil drives inflation above target. Inflation forces the Fed to hold, or possibly hike. Rate hike fears crash the bond market globally. A crashing bond market tightens liquidity worldwide. Tight liquidity hits risk assets. And Bitcoin, despite what the narratives say, is still a risk asset in a liquidity-driven drawdown. The 69,000 level is your line in the sand. If it breaks, the next stop is 62 to 65,000 before serious institutional accumulation restarts. If somehow ceasefire news hits before that, 80,000 is the first target, and fast. Bitcoin was built for this world. It was designed for the moment when governments overspend, currencies debase, and central banks lose credibility. That moment is coming. Arthur Hayes said it best. When central banks start printing money, that is when Bitcoin becomes unstoppable, but we are not there yet. Right now, the printing press is still switched off, and until it turns on, the trade is patience, not panic, not FOMO, just patience. If you are watching a specific level, 69, 65, or 60,000, drop it in the comments. I want to know where you are planning your next entry. See you in the next one.